Hey, what's going on YouTube? And welcome back to Tech Conversations. Firstly, if you haven't already, make sure to check out Moo. Right now you could earn an 8.1% APY on your uninvested cash by using my link in the description below. You could also earn up to 15 free stocks right now. Keep in mind terms and conditions do apply. So go ahead and check out Moo. I'll put a link to them in the description below. Also make sure to check out the Discord, completely free to join. So I'll put a link to that in the description below as well. Now let's get right into today's video. So I think at this point we are all very familiar with the wheel strategy. But just very quickly, for those of you that are not familiar with this strategy, let's take a look at a quick example using this stock today, ticker symbol SNAP, SNAP. So remember, usually when we're using the wheel strategy, we start by selling cash secured puts. So let's go into the options here for SNAP. For today's expiration, I'm going to select December 20th, and I'm going to go over to sell, and I'm going to go over to puts here. Now, usually when we're selecting the strike here for our put that we sell, we usually select a strike at which we would not mind buying 100 shares of the stock. So let's say I would not mind buying 100 shares of Snap at $12 a share. Then for the put that I sell, I would usually select the one at the $12 strike. So I would come in here and select this put right here. And so for selling this put, I'm going to get paid a premium. How much? 27 cents per share. Each contract controls 100 shares. So I would get paid $27 to sell this cash secured put. In exchange, I have to put up some collateral. How much? Whatever my strike price is times 100. So for this example, I would have to put up $1,200 in collateral in case I have to purchase the 100 shares at $12 a share. Now at expiration, one of two things will happen. Either the share price will be at the strike price I selected or above. If that happens, this option would expire worthless, which means I would get my collateral back, and I basically made $27. The second scenario is the share price goes below the strike price I selected. In that case, I would still keep my $27, but now that collateral that I put up would be used to purchase 100 shares of Snap at $12 a share. So now I would have 100 shares of the stock. And as we all know, with the wheel strategy, once we now have 100 shares of the stock, we continue the wheel by now switching over to selling calls. So once I have 100 shares of Snap, I can start selling calls. So let's say I have 100 shares of Snap now. Now I can come in here and sell one of these call options. And again, usually we would select the call that we're going to sell. We would select one where we would not mind selling our 100 shares at. So for the strike, what price would we not mind selling our 100 shares at? So let's say now that I have 100 shares of Snap, let's say I would not mind selling those shares at $13 a share. So for the call that I'm selling, I would normally select the one at the $13 strike. So I would go ahead and sell this call here. So again, for selling this call, I'm going to get paid a premium. How much? 23 cents per share. Again, each contract controls 100 shares. So I would get paid $23 to sell this call. And in exchange, I would have to put up some collateral. When you're selling a call, your collateral is the 100 shares that you own. And again, one of two things will happen at expiration. Either the share price will be at the strike price I selected or below. If that happens, then that means this option expires worthless, which means I made $24 and I get my 100 shares back. Second thing that might happen is that at expiration, the share price is above the strike price I selected. In that case, again, I still keep the $24 I received, but now I would have to sell my 100 shares at $13 a share. And now once we've sold our shares, we can switch back to selling cash secured put. And so the wheel continues. Now, what if we were in a situation where we own 100 shares of the stock already, and we believe the stock is fairly valued, so we would not mind selling our shares if the price goes up a little bit, but at the same time, we would not mind buying more shares if the price goes down a little bit. That's where today's strategy comes into play. So we are still going to sell our cash secured put. So let me clear this here. So we're going to go back to put here. So again, let's pretend I believe Snap is fairly valued right now. But let's say if it drops a little bit, I would not mind buying 100 shares of it. So again, we would still sell our cash secured put, let's say at the $12 strike again. But again, let's pretend I also own 100 shares of Snap right now. And again, because I think it's fairly valued, let's say I would not mind selling my shares if it went up a little bit. So I also would want to sell a call in that scenario. Again, let's say at the $13 strike. So now we're selling a cash secured put, but we're also selling a covered call. And we're doing this at the same time. Right, versus with the wheel strategy, you start with one, eventually you go to the other, then you go back to the other one. With this strategy, we're doing both at the same time. So it's a little bit different. And this is called the covered strangle. So let's go over to option strat and let's visualize this options trade here. So let's head on over to option strat. I'll put a link to option strat in the description below. Really great options visualization tool. And so if we go to build here, we'll actually see that there's already a covered strangle option here under income. So covered short strangle. So I can actually go ahead and click on that here. Then I'm going to go over to the ticker symbol in question, which is Snap here for today's video. So here is Snap. And so again, what are we doing here with the covered short strangle? So again, we should already own 100 shares, or we should be purchasing 100 shares. We should believe the stock is fairly valued. And again, we would not mind selling our shares if the stock goes up a little bit. But at the same time, we would not mind buying more shares if the stock goes down a little bit. So as you can see here, I'm long 100 shares at $12.38. Now, since I have 100 shares, I can sell a call. So again, for this example, let's say I would sell my call at the $13 strike. And let me actually select our expiration date here. I selected December 20th for today's video. So let me go to that expiration. And then again, we would not mind buying more shares if the price goes down a little bit. So let's say, again, just for today's example, at the $12 strike. And so this is what we get then. So we're selling a covered call, we're selling a cash secured put, both at the same time. So the ideal situation here, what we want to generally happen, we want the stock to trade sideways or go slightly up. So our max loss here, which we can see how much it is for this example, is going to happen if the stock goes to $0. Our max profit, which for this example is about $114, it's going to happen if the stock price goes above the call strike price at expiration. So if Snap is above $13 a share at expiration, we're going to hit our max profit here. So there's three scenarios here that can happen. At expiration, either the share price is below the strike of the put we sold. If that happens, that means we keep our 100 shares that we originally had, and now we would buy 100 more shares at $12 a share. The second thing that might happen is that at expiration, the share price is above the strike of the call we sold. If that happens, then we would have to sell the 100 shares that we had, and we wouldn't have any shares anymore. The third thing that might happen is the share price ends up between the strike of the put we sold and the strike of the call we sold. In that case, both of these options expire worthless. So we would get our 100 shares back and we'd still own 100 shares. And we could do the exact same thing again if we wanted to. Those are the three scenarios. Now remember, we should also always be aware of what happens with changes in implied volatility. So we have this implied volatility slider down here on the bottom right. So we can kind of see what might happen if IV goes down or IV goes up. So if IV goes down, this is what it starts to look like. If IV goes up, this is what it starts to look like. So again, this is why I really love this tool. Really gives you a great overview on a lot of different things. Really great way to visualize your trade. So again, this is the covered strangle. We're selling a put, we're selling a call at the same time, versus the wheel strategy where we start with selling a put, then we eventually go over to selling a call, then back to selling a put. So you can kind of see the differences between both of these. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, a link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.